This is Tom Asprey with the Viper Report. In today's free video lesson, I'm going to give you an introduction to chart analysis. Now, chart analysis is not a topic that is easily handled in a short presentation. For a number of years, I gave a presentation for new technicians. There was a day-long presentation, and we devoted 2 or 3 hours just to introducing chart analysis. Today's video is a recreation of the free video lesson that I presented on October 26, as unfortunately we had not only audio but technical problems involved in the recording. You can find past videos on YouTube under Viper Report. You can see we have all the recent market commentaries as well as those that discuss some of the techniques I use to analyze the markets. And if you like, you can subscribe to it. That way you'll get a notification when any new videos are posted. The stock market closed strong on October 25th. This is a chart of the NYC Composite and its AD lines. You can show they have the NYC All AD line. That's all issues. It staged a breakout here by moving through this downtrend a couple days off the lows in early October. It still looks very strong, well above its moving average. A similar breakout occurred in late August. The NYC stocks only AD line was considerably weaker when the market declined from the FOMC rate hike peak on September 18th as it tested the uptrend here before turning positive. It also has made a new high and looks strong. This does favor higher stock prices, as the weekly and monthly AD analysis is also still bullish. In today's class, I'm going to be discussing chart analysis. It's not an easy topic to discuss in a short period of time, so we may have more than one class on this topic. I find that the simplest way for most people to look at charts is to look at them without a lot of indicators on them. Sometimes if you have 4 or 5 technical studies and moving averages on the price, etc., you lose track of what the important parts of the chart are. Secondly, you really need to use longer term charts first. Oftentimes you'll see what appears to be a bullish daily or even intraday chart, only to find out that the longer term chart shows you that you're just running into significant resistance, and that changes your strategy. We're going to go back in time to start off this. This is a chart of Walgreens Boots WBA going up through about May of 2013. One thing I find informative for a lot of people to do when analyzing a chart is to draw horizontal lines. We've done this before when we were discussing use of the hourly charts, and longer term time frames is equally important. You can see this high in early of 2011 occurred prior to the sharp market correction into the end of the year. This was the panic low in October. Remember the rate cut problems and fears of a new recession. Also, we see that prices finally stabilized here, for a good part of 2012 until the end of 2012, early 2013. It broke out through this resistance level. So this former resistance now becomes an important level of support. That's a good way to look at chart analysis, as you want to try to identify where the market is positioned. In that case, in early 2013, all these people that had bought from 2011 through 2012 were now holding a profit. They're all bought down in this range in here. The next key level you were watching, of course, was around 37.5, as that was the resistance prior to the market's decline. Oftentimes people, particularly students I work with and those I answer questions online, think that the market, they see a very strong market trend and they think, oh, this market is never going to pull back. we're never going to see a setback, and I have to chase prices right here. Oftentimes that results in an entry that is quickly turns into a loss, and the market subsequently will decline 5 to 8%, usually just enough to stop you out of your position. You can see by this chart, by May of 2013, WBA had a strong move to the upside from $37.50 up to almost $34, and those who were wishing to buy it then would have had to risk at least down to $41.50 and more likely the $40 area. And there were probably very few at the time that thought you'd ever get a pullback back to the $37.50 breakout level. This is an updated chart that takes you through May of 2014. If we look at some horizontal lines now, you'll see that surprisingly, after that push up towards above 44, just 6 to 8 weeks later, the stock dropped all the way down to the breakout level, as indicated right here. This created a new range, and then the next level, of course, you were looking for was a breakout above 44, 45 level, as I've drawn here. Subsequently, we had another consolidation period and another breakout to the upside. This level was about 55. We moved up to 62 and then almost came back to 55, more than a 10% correction. The importance of this is to show to you that you do not have to chase prices. The market will often give you many more opportunities to get in the market. Once you've drawn these horizontal lines, then sometimes a trend line becomes more significant. You can have the major uptrend here, but you also have some additional trend line levels, such as what I've drawn here, that are a little more. So you can see that the second line, it was showing you several ways that right up here at 62 that, well, maybe the good support here was between 54 and 56. It's important to note those levels, record them, and of course in a program like stock charts or whatever you're using, I suggest you save your chart analysis so that the next time you look at that market, you'll have those lines already positioned. Successful investing or trading is all about risk control. That's why it's important you know what the key support and resistance levels are in any market, whether you're a trader or an investor. Here we have Verizon. It's been a stellar performer throughout the bull market. You can see we had a similar sort of breakout here in late 2011. Moved up to a high of about 29, dropped back down to the breakout level at 26. Then a little more irregular level here. We dropped back down to this level, also a period of consolidation. This high from 2012 was right around 34.50. It ran all the way to 42 roughly, and then came all the way back down to 35. So that was almost a 20% decline. And these levels would have helped you determine, and also they can be useful if you're fortunate enough to be long a stock and it runs from 34 to say 41 and it's a 20% move, and you're saying, well, boy, this looks great. Half of you says, I want to hold on to this forever because it could be an $80 stock in the next 6 months. Or the other half would say, well, okay, I've got a 20% gain. It's up here around 41 or so. Where can it pull back to? And this sort of analysis will tell you where the key support levels are and maybe help you decide whether you want to take some profits on part or all of the position. Let's look at the current chart of Verizon. Obviously on a lot of buy lists because if it's over 4% yield, you can see that its key support level here is around 29. Now, I was trading it well above 61 just over a week ago, and it was being touted by a number of analysts on Wall Street, but quickly came down $2 since then. So secondary support levels are that last low around 57.50. That's sort of your first stop level, could be down to under 57. Much stronger support, is in the 53 area. So that gives you, oftentimes you'll see a stock will break out of a range like this and then we'll come back in there. And that'll create a much more favorable risk-reward entry level. Let's take another favorite. That's Microsoft. Had a strong surge in the past couple of weeks. We can do the same sort of horizontal analysis. We broke out of this level at around just under 24. Rallied all the way up to 27, and lo and behold, that was in looks like early March. By the summer and back into June, it was back down to 34. So that was a $4 move on a $28 stock, so 12-15% correction, and it got even lower than that. You can see that it came back down even to the further breakout level. This is where your technical analysis, the methods I've discussed using the on-balance volume and relative performance analysis, will help you pinpoint these turning points. Of course, you also look, to look at, chart formations. So one of my favorite chart formations is where a chart forms a triangle or a flag formation after a sharp move to the upside. So you can see we ran from roughly 19, up to 27. We came back to 23, about 50% retracement of this entire move up. After we broke out in April of 2013, then we can look again at some of the horizontal support and resistance levels. Ran up to 31, came back down to 26.5. Now this may seem simplistic or redundant to some of you, but it's something that you need to focus into to really understand charts. I've been looking at charts for well over 30 years, and by spending a lot of time and looking at them very closely, I can look at hundreds of charts and quickly look at ones that interest me for the week or the month ahead, and also file some other ones for future research. It's not a skill that you can just pick up immediately. It does take repetitive work. What I suggest to people that I mentor, I do a lot of training with people to help manage their portfolios, help them become better traders, analyze their trades. Some talk to me about, well, here's what I'm thinking of doing. What do you think? And I'll give them my technical opinion on whether I like the stock or ETF and whether I think it should be bought or sold. But I suggest to them that depending on their personal life, they set aside some time each week at a minimum or even a day to look at 5 to 10 charts. Start small, maybe 20 if you've been doing it for a while. And if you have 4 children under 12, maybe half an hour a week is going to be the best you can do. If all your children are in college and your significant other is understanding, you might have an hour or 2 hours on the weekend. By doing this, you will gradually gain the skill and the expertise to analyze charts in a pretty quick fashion. So you can see we had some various levels, same sort of repeating pattern. Strong breakout above resistance, pull back to support. Breakout above resistance, pull back into support. Breakout, pull back, etc. Last week, Microsoft reported earnings, very good earnings, and so also it's a very attractive stock in terms of growth as well as yield. Let's look at its important support and resistance levels. So you can see I usually start going further back. This chart roughly has just a year of action. You can see another key level of support here is at the 130, one area or so. We had a low in late July down here, and we're now in the upper end of its range. So it's still within this trading range. So a stock right here, you're going, well, okay, if I want to buy it right here, my initial risk is down to under this low, which is probably a stop under 130. So the stock trading at 140, you're risking $10 on a $140 stock. That's a little high for me. That's more than 5%, which is my threshold. But also, you can look at the horizontal trend analysis, see, well, okay, 37.50, maybe down to 135. Then you're looking at $5 of risk at 135, and risking to under 130. That's less than a 5% risk. When I started out doing technical analysis, the only way to see a large number of charts was through chart books. I subscribed to something called Mansfield Charts, which was used by most institutional traders, including one of my mentors, Stan Weinstein, who wrote a very successful stock letter for many years. He is most known for his stage analysis. That may be a topic for a future class. He's only written 1 or 2 books, but his principles and his guidelines still work, in my opinion. Of course, now we have the ability to see a number of charts and a number of different services. Stock charts, is one that I use. One thing is nice about it, you have this candle glance. So this is the main page if you're a subscriber. You can set up for a trial for a month if you're not, and you can see if you like it or not. So here we have, a market movers page, and it has a candle glance. Will give you a reading of all the charts of those in that criteria. I use this sub thing to look at all the Dow stocks. Of course, these Dow stocks are as of Tuesday, October 29th, but it allows you to look at all the charts of all the Dow stocks in one panel, telling you which ones are looking interesting and which ones are not. Even simplistic analysis. You can see IBM, of course, it was shellacked and it's been trying to stabilize here, but you can see just even this moving averages shows you, okay, 137.50, 134, that's might have a problem. McDonald's got smacked last week. It continues to move lower. It was on that article I wrote a couple months about the most oversold Dow stocks. So it's even going to move further to that list with this week's action. This allows you to decide, oh, okay, well here, this list looks interesting, and why don't we focus in on, one of these stocks. One of the simplest techniques that I teach people is to run just a very simple 20-period exponential moving average. It's very effective on the weekly data for the major trends, and on the daily data, it'll help you determine where you should be looking for a buying opportunity or whether the stock or ETF is overextended. This chart is of Home Depot, which has been a stellar performer throughout the bull market. Let's do a combination here of, once again, our horizontal trend analysis. We start at the end here, so we hit like this was the first support level around 32. We had a pretty nice move up here to about 45. Came right back down to the breakout level, which turned out to be around 38.5 or so. Another upside breakout. Another. Sometimes you'll get a zone. We made a new high here in 2014, and we moved sharply higher, but then we had a zone of support. You can see back here that when you look at a chart, and one of the things I will look when I scan, sometimes I come up with more than 50 to 80 stocks in my scan for my Viper Hot Stocks report to review. One of the things I look at to decide whether I'm interested in buying or selling is how it relates to its 20-period exponential moving average on a weekly basis. So you can see that there are a lot of pullbacks here for Home Depot. We came back, made a significant high, came back to its 20-period, rallied again back to those highs, came back to the rising. It's rising, so it's the trend of that. As long as it's in an uptrend, you should be looking for pullbacks to that as a good buying opportunity. When it's flattened out, it's a little difficult, or if it's declining on a daily basis, it tells me that, okay, it's too early to jump back in. So you can see as the chart was ending, we had some really good support in the 72.50 area, and we'd made it up to 85. This is the current chart of Home Depot as it's continued to make significant new highs. So once again, we have initial support here just below $200, and more important here at the 185 area. We pushed up to just about 210 in September before this current pullback. So those are the support levels. Once again, for the most part, the 20-day period average has marked a correction low. You can see that, and continuation patterns. Those are pauses in an up or a downtrend. We could do the mirror image of this, and we could see that rallies in a downtrend often fail at the 20-week EMA. In this case, we found support down there. It held above that longer term, but it was right back to this support that was formed before the market made a new high. So we moved from 135, up to 150. Many people said, I got to buy this thing. It's going through the roof. There's, coming into hurricane season in 2017. And most people said, well, I don't think I'll ever be able to buy it back at 135. Of course, it was exactly what you were able to do just a month later. So that's important to give you that perspective that, never, back in the precious metals craze, analysts used to always remark that, there were some unscrupulous coin dealers that used to call up and say, you have to buy this platinum coin by Friday. Well, in the investment markets, you never have to do anything by a certain day or week. The market will always give you lots more opportunities. That's why I often tell people if they're having, if they're distracted, they have something going else on in their life, that it's not a good time to trade. You're decreasing the probabilities you have of success by trading or investing when you're in a stressful environment. This daily chart of Home Depot will give you a much different perspective, but the same sort of principles will apply. Let's take a look at this daily chart. This is a current daily chart. You can see that we had a nice little low around 155, and since then we've had a series of significant new highs. This is probably the longer term uptrend here, now around 210. You have to remember that the more number of points to develop your trend line, whether it's an up or a downtrend, the more valid it is. So for example, we could move this up, to encompass the May low, and you can see we just dropped slightly below it. This is where you look at your technical studies, where the technical studies acting stronger or weaker than prices in August. And what did that tell you about whether this is a buying opportunity or a selling opportunity? Then you can look at your horizontal lines again. Going back to the start in, you can see this was a high that was formed in November of last year. We broke out above it early in the year, rallied to a high of 205, came back. Where did the correction end? Right at that level, around 183, 84 level in May. So now we're looking at, we came back a little below that April high, but not a lot. Held that uptrend. Now we're looking at, maybe, 220. We've just slightly broken out above this high. And so, it always tells you, like, well, where's your risk? So your risk is 235. Your risk is down to under 220, say. So $15. And $15 is, more than 5%. 235, 5% would be roughly, about a $12 risk, and you have a $15 risk. So that's just, I put it into a spreadsheet, calculating the risk, and, because I know that if you're correct 60 to 70% of the time, and your trades or investments have a 3-to-1 or greater risk-reward analysis, you're going to make money. If you have, that same win-loss ratio, and you're risking as much as you have the potential to make each time around, it's not going to be a profitable experience. could make a small amount of money, but you're going to be generating lots of frustration in the interim. So that's why the risk reward analysis is positive. That's why the risk reward analysis is a critical step, whether you're investing or trading. There are a number of great sites out. Another one I like to look at for chart ideas is Finviz. See, Finviz.com has some pretty annoying ads, but they got to stay in business too. So nice thing about it is, let's say we put Home Depot in there. You click on that, you'll get a chart at Home Depot. They draw their computer-generated trend lines and channels. Can't find a lot of fault about that same sort of trend line we had before. And nice thing about this is if you click on home improvement stores down below here, you get a list of all the home improvement stocks. Not too many in that category, but they're a fair number. And also you can go to here to say charts, and you'll get charts of each one of those. So here, not that many to really look for, but you get a quick idea of what you're looking at and whether anything looks particularly interesting. See, Lowe's has a much different pattern right now than Home Depot. But let's go back to that. Let's look at something like Microsoft, which is a much broader category. So we click Microsoft, we get the same daily chart, business software and services, you click on that. Here you have 3 pages of stocks. Okay, so that's way too many to look at. I mean, if you were to look at the charts, you're going to see, all these charts, 3 pages of charts too. So that's probably a little bit more. So what I often do is to, I'm trying to cut out the ads, and it's a losing battle. Hit the average volume here, and say maybe over 1 million shares. Now, then you're going to have it back to just 1 page. You can manage that. So you can look through all these charts and say, okay, well, these are the similar. Citric System, pretty bullish chart, but same sort of thing. Horizontal analysis here says 102, down to 98. Other ones, Sale, I've never heard of that one. Doesn't look particularly good. Anaplan, it's had a nice move up. This looks like a pretty normal sort of correction, so that's something I'd be kind of looking at, particularly down in that 45 range. I'd be running my other technical studies. SSNC, still in a downtrend. So this can help you, find some ideas to look at for new trading opportunities. Another one that I use quite frequently is to look at the sector analysis. So you can look at, once again, back to stock charts, you can say, okay, let's look at, sector summary. Okay, so let's say, all right, sector summary, this particular day and time, healthcare is looking pretty good, so I can hit on the healthcare sector. I can find these subgroups. I can either look at, today, medical supplies and healthcare providers are the 2 of the best ones. So we can click on this little sharp chart box here, and we can see a chart of that industry group. Okay, that tells you whether daily chart looks pretty bullish here. The other way you can look at that is to, which I also teach to my students, is that if you hit on healthcare providers, you get a whole list of all the healthcare provider stocks. You can see at this point there are 82 different stocks in this list. So they tell you whether they're their SCTR, that's sort of a strength rating, small cap, change, etc. Tells you the leaders, click on that, or the losers in that group. So clearly a lot of information out there. The challenge for the investor and the trader is to be able to focus and develop a plan of their own that you can repeat, and more importantly, you have a concentrate. You can have the confidence to follow it when it's time to put your own money to work. During my free class, I also covered requests from the audience for a couple of individual stocks. Probably not going to include that section right now, but that's something I usually do if we have time during the normal free class. I'll probably do another one of these between now and Thanksgiving. A couple things. Please, when you get an email discussing this video, or if you see it on YouTube or on Facebook, please get a hold of me and fill out the survey. It's those surveys I use to determine what I teach in classes going forward. Chart analysis was one of the more important ones. What feedback I get from this section, will depend on how much more time I spend on chart analysis. It's a very vast subject, and I think I probably demonstrated that with this just short class. If you are not a subscriber to my premium services, obviously I'd love to have the business, the Viper ETF or the Hot Stocks Report, both of which give specific recommendations, with profit loss targets, stops, etc., and then following careful adherence to risk analysis. Both reports come out twice a week, usually Mondays and Thursdays, with interim reports when necessary. And new subscribers get 6, trading lessons, explain some of the techniques that I discuss in my videos, as well as the ones that I use in my analysis. So it'll give you a good heads up on the more important things I feel about technical analysis. One of the most important facets of my analysis is determining the market trend. And that's based on the AD line analysis, on the Viper Report homepage, where you can sign up through these links to the Viper Hot Stocks or the Viper ETF Report. There's an article called The Survivor's Guide to Market Corrections. This will take you through some past corrections, shows you the commonalities, shows you how the AD line not only helped identify the market's decline as it did last fall, but also identify the bottom, like the important bottom in 2016. This you'll find very informative. My students that have taken this course have generally improved their performance very significantly, and they're trained to look at the AD numbers on a regular basis, day in, day out, week in, week out, and month. Doesn't take a lot of time, but it can be very, informative and helpful to becoming a better investor. If you're interested in the course, I have a couple spots left for the end of the year. My intensive advanced decline line course. It goes through 6.5 hours of training at least with follow-up. It's $8.99. That's just one-on-one with me. And I also do individual mentoring. I have students who come to me once or twice a week and say, here's what I'm thinking of doing, buying or selling. What do you think and why? So I use that as a training lesson. Others, I try to help them manage their portfolio to see how well positioned they are for where I think the market's going. So great. Hope you benefit from this class, and thank you very much.